Hi, this is Jim Welsh from macrotides.com, and this is a Micro Minute Update. This morning, the Labor Department reported that in April, only 266,000 jobs were created, compared to estimates of 1 million or more. There are a number of reasons why the jobs number fell short. One of the primary ones is the unadjusted job number actually was over 1 million, which suggests that the Labor Department is having a difficult time with their seasonal adjustment factors. And this is understandable given the volatility that we've seen over the last 12 to 15 months in terms of the jobs report and what's been going on in the labor market. There are other factors as well. Although vaccination progress has been amazing, it's going to take a little more time for companies to really, truly reopen. And I think that's one of the reasons why we saw a lag in job growth. And the incentives by the government of unemployment benefits is having a marginal effect as well. If you're worried about the virus still, and the government is paying you more than what you would earn if you went back to work, you're going to sit on the sideline. I would not overstate this factor. The key point here is whether it had been $1 million job monthly report or the 266 that we got, neither number would have changed Chair Powell and the FOMC's perspective in terms of we're going to wait for unemployment to come down and we want to see inflation above 2% for a period of time. And I think that's the key point. I think the jobs number that came out this morning is a head fake. Now, in the weekly technical review from May 3rd, some important things I'd like to point out. In the technical review, I anticipated that the 10-year treasury yield would drop below 1.52% before resuming its uptrend. This morning, the 10-year yield dropped to 1.471%. Gold. In the weekly technical review, I anticipated that gold would rally to 1820 to 1840. The high today so far is just above 1840. The anticipation for the dollar was that it would continue to decline and I think potentially drop below the January 4th low of 89.21. So far, the dollar has dropped to 90.21 after the employment report and the perception that the Fed won't be doing anything with either tapering or rates anytime soon. And finally, in terms of the S&P 500, the expectation was that the recent pullback was a wave 4 and that we were going to see the S&P rise above 42.19. The high so far today is 42.38. Thanks for tuning in. Hope something happens for you that's great today.